Really nice to meet you. Thanks for joining us. Start off, could you tell me a bit about Dundas Global Investors? And I think, importantly, what do you think is unique about your investment philosophy?
James, thank you. Well, the firm's easy to describe. So there's 14 of us. We operate from Edinburgh. We have one office in what we call the New Town. It's about 200 to 250 years old. 9 of the 14 are partners. We've managed global equity portfolios in the way we're about to discuss for Australians since 2012. And those would be the broad descriptions. But the things that define the firm, getting towards your question about what sets it apart, the first thing is that it's completely independent. It's owned by the people in the firm. There's no external investors. And what we're doing is exercising our independent judgment about what's going to deliver the best investment returns over the long term for the firm. The background of the people who got this going was really in funding pension funds, superannuation assets. So our bent is toward, we tilt to the long term, and that is the way the firm is organized. We only have one strategy, and that's the strategy of dividend and capital growth that you and I will be exploring in the next few minutes. So I won't dwell on that just now. But perhaps where it starts to really be particular is that we only have one strategy. So we have a global equity strategy. And here in the UK, we have a fund that is the same as the fund we're talking about, the Apostle Dundas Fund. So the UK fund has our money in it. And that's all I own. I don't have any other investments, apart from some private equity, some venture capital things based here. But my public equity investments and the vast majority of my own capital is in that fund. So in having conversations like this and talking about the fund to Australians, we're actually, we're not seeking clients. If people join us, they become co-investors. So there's no, you'll be familiar with the problem of the principal and the agent. Well, we've just taken that away. So we're fellow principals. From day one, we've done our own research. You'll be familiar with the struggles inside the investment banking industry and the research industry globally. And the tying of that together with brokerage was something to be separated, in our opinion. Anyway, we started the firm at the point where we entered the age of information abundance through investor relations websites, through online systems, through trade associations, all of that. And so we do our own original research on the companies that we're considering. But the key feature in all of that, and if you piece it all together, is we've sought to have the simplest possible structure. So when we come to work, we're thinking about, will this company enhance the portfolio? Will this one detract from it? And there are no other questions. And perhaps the best way to illustrate that is, if you think of any medium-sized global equity and fixed income shop nowadays of a few $100 million, 10, 15, 20 strategies, lots of people, very robust systems. But when an idea gets in the building, how does it get to the right place? And the management of that internal complexity can become the complete preoccupation of those organizations. I'm not saying they're bad. I'm just saying that they have a big headache before they even get looking at the stocks. We've just stripped all that away and focused it exclusively on running this single strategy. So there are 3,500 stocks in the world that we could invest in based on their size, which is a minimum of $2 billion market cap. We invest in 67 of them. So it's a very simple firm. The last thing, when we set it up, we could see the pressure on fees that was coming from around the world, which I welcome. I applaud it. For far too long, intermediation has captured client savings, not enough to the client. So we set up a low fee model, so we're future-proof, and that's a big plus. So you said unique, very strong word, very strong word. But I'll take very unusual because of its simplicity.
I was about to throw in there, I was going to paraphrase and say it sounds like a simple structure. lean, simple. I guess removing the layers allows you to see get those ideas, and I think that alignment is something that resonates, and some foresight on the feet.
I think the information management problem in complex organizations, multiple sites, multiple strategies, multiple objectives. I mean, you mentioned one or two larger fund managers, and you mentioned one that's based in Edinburgh. The lacking firms that are built by acquisition, lacking a single common purpose other than shareholder return, well, then you can focus on the other side of our industry, which is asset gathering. And our view is if we invest our own money well and invest it well for our co-investors, things will take the natural course. And I'm glad it's not a moral judgment on the other things. It is a judgment for simplification relative to needless complexity.
So you mentioned the universe of stocks that you're able to invest in. You narrow it down to 60 to 70 stocks that make it into the portfolio. Part of that is, how you drive returns, and there's a big focus in your process on both capital growth and also dividends. Why is it so important to focus on both?
Because both are important. And the so important part is that it's easy to lose sight, because the one with the biggest drumbeat every day is the movement in share prices. So they're in our face every single day. Mr. Market has big, loud instruments that he likes to smash very hard. And we're all experiencing some of that just now. So the noise from that part of the orchestra can drown out the other part. Anybody who is a moderately serious student of equity return and how it is arrived at, and all you have to do is look half an hour do Google search and get up with some of the material. We know that the key components of long-term return are compounding inside companies and compounding dividends. It has become even clearer that dividend growth is the key component, and that's supported by research, by academics, by index firms, and others. That's a longer, lower part of the noise of markets. And so we don't have a special insight here. We haven't discovered something. What we've done is we've focused on what is commonly understood, but is so hard to do because of the drumbeat of Mr. Market. So the focus is on the key component of return, long-term return, which is dividend growth. And so that's why we focus on it. And starting the firm with our own savings and our own capital enabled us to just cut away everything else and decide that dividend and capital growth were, we didn't decide it. We discovered it. It was mentioned to us. And so having made the discovery, the thing was then to discipline ourselves around the pursuit of what really matters in the long term.
So dividends, I'll give you a stat. Over the last decade, 86% of return from the ASX 200 came from dividends.
You rest my case.
So for Australian investors, there's a perception they should be fishing in local waters for income and looking abroad for growth, for that capital growth, and finding that drumbeat that you've talked about. Could you share with me one or two compelling reasons that investors should look more globally for income opportunities?
I've heard that couplet, and so let's see how it rhymes. The case for Australians investing at home for dividends, or indeed any people, so people in the UK, people in the Netherlands, people in Canada, investing at home for income is very strong. And there's a few obvious facts. So the first one is, if you invest in Australian dollars or British pounds, and you buy companies who pay dividends in that currency, there's a very simple currency match, very attractive. Secondly, all those jurisdictions have to deal with the double taxation problem. So the company's profits are taxed and the income, the individual pays tax. And in varying ways, they address that and recognize that they've got to, they can't really tax people twice completely. Your system, the franking and imputation system, is one of the most elegant in the world and one of the most generous. What generous is, I think the Australian system is the way most places should be, but it's a great system for the private investor. And the final thing is, if you invest overseas and you're relying on it for your dividend income, there's all the other hassle of custody costs, foreign exchange costs, withholding taxes, and so on. So let's start with the first part of it. Staying at home for income. There are really strong reasons for doing that. But if you look a little deeper, the problem becomes more obvious. Yield and dividends are not identities. We've had a problem in speaking to, certainly in Australia and in some other places, we've talked about dividend growth, but what people have heard is yield, which is the relationship between dividends and capital. It's dividend growth that drives return, not yield. Yield is very important, but over the longer run, dividend growth. Now, Australia's dividends rely on two industries, principally, not exclusively, but principally. A very mature banking system, which really has one asset, residential property, and commodities from coal to iron ore. Long-term investors have to prioritize dividend growth. So in one sense, by focusing at home for dividends, we've answered that part. But in terms of focusing on dividend growth, that's a bet on those industries, plus CSL, plus Seek, plus some of the other companies that are available to you. Dividend growth depends on industries and companies, not domicile. So easy money from a favorable tax system is a very poor substitute for hard analysis. And that's true for Australians, it's true for everybody in their other countries. Last year showed the perils of relying on a small group of companies for high current income. And set in a wider context, we look at banks around the world, and the big four in Australia candidly have struggled through our sifting even to get to the intermediate rounds in terms of the underlying challenges they have. So I think the answer, to go back to the couplet, home for income and overseas for growth, there is no question that the dividend advantage for Australians means that they should fully take advantage of it. But remember that the real underlying powerhouse for your return is dividend growth, not current yield. And on that test, pick the best of Australia, but pick the best of the world. There is 50 times the opportunity outside Australia as there is.
You've got my mouth watering with your talking about the characteristics of the companies, and I want to hear an example. Hoping maybe you could talk me through just a little bit about how you find how do you find those companies that you want to invest in. You describe your process as sifting rather than filtering. So maybe talk me through that sifting process and maybe bring it to life with a case study if you could. I mean, I think that's the best way to talk through it.
Delighted. Well, the sift versus screening discussion is pretty simple. So sifting, and it's intended to have a picture. It would evoke a picture. And the one it evokes for me would be somebody panning for gold or sifting the material in the garden and putting it through the grid. That's what we do. And I mentioned earlier on that the firm started in an age of information abundance. And what that meant was that the shoe leather and air miles remain important to finding stocks. But a long time ago, when I get started in the business, they were the only way you could find stocks. That's not true anymore. So when we sift, we're sifting through that 3,500 stock universe. Now, helpfully, the kind people at MSCI and FTSE and the other index compilers, they group things logically and very well. Their taxonomy is good. So when you look at car companies, that's what they do. So what we're able to do is look at these industry groups, retail, car companies, pharmaceuticals, and so on, and sift through them, by which we mean we look at each individual company, we look at its financial record, we look at its products, we look at the possibilities, and we are unashamedly backcasters. So forecasting is important, but we like backcasting. And backcasting tells you how people have coped with the circumstances they faced that we both understand. And that tells you something about resilience and continuity. So what we do, having sifted, is we discard the ones that we think don't cut the mustard, and we focus in on a smaller group. We look at them individually, and then we discuss them as a team. That's it. What's the advantage of that? Well, we've never owned a telecom stock, but we've written about Vodafone, we've researched Telstra, we've looked at Singapore Telecom, we've looked at Bharti Airtel time after time after time. Why? Because you learn about that industry, you learn about its supply chain, you learn about how that interacts with app stores, you learn about the relative pricing power between them, you learn about the shift from print media to digital media, and so on. And so by sifting, the way I describe it is you're addressing the world as it is, not as you would wish it to be. And it's possible to do that even in a firm of our size, because of the extraordinary access to data and information that we have today compared to the past. So the ideas emerge from the sifts, and really what we're looking for is the ones that stand taller. Now, I should say the first part of our sift is discarding. And we're letting things go. I mean, you could say you picked up, we've got a 67 stock portfolio. It is equally possible to say we have 3,440 stocks that the most important decision is not to own them. Those decisions have equal value. And so sifting is about understanding those two things and what you learn from the process of doing it. Now, the way I think best to illustrate this is to think of the opposite side. So let's say, James, you and I were talking about a European small cap value fund. And you had the 3,500 stocks. Well, first thing is you take out all the non-European stocks, and then you screen by market size, and then you've got some criteria for valuation. So your criteria, pre-decided, take you to that group of stocks, and there'll be 140 of them just now, maybe 300 then. Yeah, 300 more likely. What have you learned in the way past? Nothing. If you went to Sunday school when you were younger, seek and ye shall find is one of the things that you have heard discussed. And if you've put the glasses on of that tint, that is all you will find. And so we think sifting is a far more robust, far simpler. It's more perspiration than the inspiration of the screening criteria. You may be right. That may be the best 150, 300 stocks for the next few years, but that's luck. So we sift because that's what we're looking for. We're looking for the things that emerge rather than the things that in advance we've decided will be better. Let the facts tell us, not the other way around.
So does that mean you need to be market cap, industry, index agnostic in the way you put your fund together?
Forgive me, agnosticism is about not being sure if there's a God. I'm absolutely sure all those things exist. The agnosticism is that just because they're there means only that we should know about them, that they exert no gravitational pull on the portfolio because of those characteristics. So 2 billion to trillions, not interested, because from the amount of money we manage, the size we are, that will never be a burden for us. So we need to exercise that freedom to be agnostic, not the certainties of the other two extremes.
All righty, you're drawing me out. I'm wanting to hear about a case study. Can you talk me through a live example of something in the portfolio, a really high quality dividend grower that exhibits the traits that you're sifting for?
Well, I'll tell you about the most recent one we bought, if that's okay, because it's the most vivid in memory. So when we started, and we started in this process, this repetitive search, sift approach. Some of the things that emerged were about the transformation of our factories around the world. Transformations of productivity, the role of computer-aided design and computer-aided manufacture, At an earlier stage in my career, I met a few CAD CAM companies in the 1980s, and they tended to operate in silos where they produced material that then went to the design people who would transform that into drawings and material that would help people build cars, planes, boats, other devices. That has moved on enormously. And in all the work that we've done, speaking to industrial companies around the world, speaking to manufacturers, we've learned a great deal more about the integration of their supply chains, the integration of computer-aided design and manufacture and test, the growing integration of the semiconductor industry into much wider walks of life. You'll have seen in the press recently the global automotive business is being held up, and it's having a problem now that the semiconductor industry is a big part of its supply chain, and they lived as really two separate groups for a long time. So the more we delved into and sifted through the industrial companies and their suppliers, one group that time and time again came up that we decided to have a deeper sift into is industrial test and measurement businesses. And the one we bought in December is called Keysight. Now, its history is so interesting. We'll just take a moment to talk about that. Back in 1938, two young engineers, Mr. Hewlett and Mr. Packard, started their famous company in the garage in what became Silicon Valley. And they built Hewlett Packard. We tend to know it today as a computer company, a printer company, or an enterprise software company. But for the majority of its life, it was the world's leading electronic test and measurement business. In fact, their first customers, I think from memory, they sold 8 devices, I think to do with audio testing, to the Disney company when they were making Fantasia in 1939, 1940. That was the beginning of the business. Well, as Hewlett Packard grew into, I think the kindest term you could describe, a rather bloated, ill-structured behemoth, the board of Hewlett Packard started to restructure, and in 2000 they spun out a business called Agilent, which is a medical technology business, and inside it was the original Hewlett Packard test and measurement business. And then in 2014 those two businesses split in two, and so Keysight Technology is a US company, and interestingly it is the original Hewlett Packard company. It's the same number in the Californian and US corporate register that Hewlett and Packard had. They just couldn't use the name. Now, what's attractive about it? Well, going back to the sifting, we could see from all of our work that test and measurement that used to be an after you've made it test of the product you were making is now becoming ever more deeply embedded in design, procurement, manufacture, and test are a single continuum, much more than a series of discrete functions. Keysight's got 32,000 customers built up over 80 years of Hewlett Packard's operations. That'll do. 55% of those customers are served directly, and the rest they distribute. But the key thing, if you'll pardon the pun on the name Keysight, the key insight of Keysight is that if you think back to those engineers at Disney and Fantasia, guys in the white shirt, short sleeves, button-down collars, all the pens in the pocket, they would read from the device and write something down and then use it elsewhere in the building. Keysight's products and its peers' products are now software enabled and built into units so that data, without human intervention, is taken and used at different parts of the manufacturing process. Now, this is a company with over 60% gross margins. It's taken, I think, probably a bit longer to restructure into its own self after being spun out of Hewlett Packard and then Agilent. We think it's in a very important place in the future of manufacturing. There's been a lot of talk about reshoring. Donald Trump talked about it, the Brexiteers talked about it, and just because it comes from mildly disreputable sources doesn't mean the point is badly made. But as manufacturing activity is being spread around the world again, the labor content is less and less the important thing. The more important content is eliminating error and flaw and bad product that can't be sold. And test and measurement is deeply embedded into this. So Keysight's very strong in electronics, and it's very strong in communications, and so products are associated with what's happening in 5G. So how long did it take us to find Keysight? 10 years. How many stocks did we sift through to be convinced that the demand for its products and services is strong? Hundreds. How many in the end did we sit down and compare and contrast before we bought Keysight? 4 or 5. And that's sifting. Oh, and by the way, we own Disney. So I don't know if they sell to them now. I imagine they do. But so I hope Disney is one of the 35,000 customers. But that's an example of how we go about it. And that's why I'm optimistic that it's a robust process and philosophy.
So Alan, final question, but it's a doozy. We've started running a series called Stats Incredible on Livewire. And so I wanted to give you the opportunity to choose an incredible statistic from all the research and sifting that you do that highlights the global opportunity for Australian investors. So could you blow my hair back with an incredible statistic?
It's a very simple one. The challenge is facing all of us as long-term savers who will eventually consume those savings is to beat inflation, to beat the corrosion of our wealth by being in the wrong industries, inflation cutting it back. If you restrict yourself to investing only in Australia, you're buying 2.9% of the world's dividends and a lower number than that of the world's dividend growth. The opportunities elsewhere are multiples of what's available at home.